Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake. My name's Gaurav Sodhi. Joining me today is analyst Graham Witcomb. Hello, Graham.
Hi, Gaurav.
And with us also is analyst Nick Cummings. Hi, Nick.
Hi, guys.
Gents, exciting news today. The kids are in charge. There are no adults in the room. It's just the three of us. John's not here. We can go wild. What should we talk about? We should also add that usually John prepares these podcasts and we're kind of coming in blind on this one. But never fear, I have some ideas. First of all, gents, I don't know. Let's do a little bit of chit-chat. What's happening? Nick, the international front, I've been amazed at the rip in Aussie markets. And the international stuff is ripping just as hard. Are you concerned about this, or is this are you just taking the money and happy?
Oh, no, I'm concerned a little bit. It seems like only yesterday that we were talking about trade wars and everything going on with Trump, and that the collapse of the US dollar, bond markets were going to implode. And I think some of these are all still, risks that are out there. The international stocks rising, some of that I get. There's been a catch up with maybe some of these European businesses that have been forgotten about. And if you look at just the Mag 7, I know we talk about it a lot, but apart from a few of those businesses, the valuations aren't crazy. They're not, outlandish. I mean, even, there's a lot of question marks about a company like Google, but you can buy that business today for about 16 to 18 times earnings, depending what you want to do with the other bets divisions and net cash and et cetera. So I don't find the valuations crazy. Whereas if I look at the ASX top 50, oh boy, it's getting to, I think, almost like psychopathic levels. And, the poster child's CBA, just because not only the multiple, probably the most expensive large bank in the world, maybe ever, but also just the lack of earnings growth. And you look at Australia and we don't have much productivity growth. There's a lot of uncertainty. There's not that many new great businesses coming through, and it's really hard to see how this index is going to grow its earnings to sustain this multiple.
Yeah, no, I completely agree with that. The ASX, I agree with you on international stuff as well. The international stuff I get, I'm actually I believe the AI hype. We'll come to scary words in investing, but it's different this time. I was near the top of that list, and I think it is different this time. The ASX is, you used the term psychopathic. It's getting completely divorced from reality, those top 50 stocks. It's hard to justify. Graham, over there in Canada, you're used to things being unrealistically high priced. Does the ASX sit well on your Canadian list as well?
I think it does. When you do go down the list of the top stocks in Australia, it almost seems like an outlier. Australia's always given this impression of the lucky country. And I think when it comes to stocks, they do kind of stand out against the world for all kinds of reasons. But kind of like you, I believe a lot of the AI hype, and I think that maybe this time is different. And some of Australia's stocks do stand to benefit a lot. So it's hard. I think they look overvalued compared to a lot of the international names, but I wouldn't rule them out as being undervalued compared to their long-term potential.
All right. Dissenting view. Okay. We'll accept it. We'll edit that out later. The second scariest phrase in investing, after it's different this time, is probably company transforming acquisition. What do you reckon? Would you agree with that? That's pretty terrifying.
Synergies,
yes. Synergies combined. Well, we're hitting it all here. Yeah, all of those combined in a single sentence is pretty common. And they ought to send waves of terror through your blood. We've had a couple of quite large acquisitive moves of late. We don't want to go through all of them, but Nick, some acquisitions do work and some acquisitions don't. I think when you've been in the market for a long time, you get a bit of a radar about what's going to work and what isn't. What's on your radar? What do you look for in a successful acquisition?
Yeah, I guess it's a bit subjective to to each individual investor. But what I'm looking for is first off is the size of the deal. So is it a small deal? Is it a large deal?
The bigger the better.
The bigger the worse. Yeah, I'm really looking for companies that are making sort of tails we win, heads we don't lose much kind of bets. I mean, transformational acquisitions. I haven't done the numbers and I don't know the track record, but it can't be good. It's almost an immediate red flag when I see that word in an acquisition presentation, and automatically almost a sell signal.
A sell for me too. Yeah. Transformation. Yeah. No, I agree. That's an automatic sell for me too. Yeah.
Yeah.
Sorry, go on. Carry on.
No, that's fine. The other one is the strategic rationale of the deal. If I see an acquisition presentation, which is very common, particularly on the ASX, where there's 15 slides and 10 of those are on earnings accretion, the financials, the synergies, and how beautiful this is going to be for our share price, and there's 2 slides, like throwaway slides, on the strategic rationale of the deal, that's another red flag. And ideally, you want to find acquisitions where either both sides are bringing something that the other doesn't have to the table, or one side's doing something for the other that really accelerates that business. So, like, a really simple example might be you might have a more mature company and targeting or trying to buy an immature company that has some innovative product, but the mature company has these established relationships and established products that are complementary to this potential innovative product, and that they can just cross-sell that, distribute it through their current channels and really accelerate that target.
Classic.
Yeah,
classic. That target. Absolutely.
Business. And that's what I'm sort of looking for. The other big red flag, or there's a few big red flags. I mean, overseas acquisitions, they're don't have a good track record.
Yeah, I feel as though Australian investors are savvy to that now. I think companies are very cautious about overseas acquisitions, and they go to a lot more trouble to justify them than they used to.
Yeah, 100%. The other one is acquisitions in manias or bubbles. I mean, you're a commodity investor, Gaurav. You see it all the time.
I see it all the time.
But one of the worst ones I think we've seen over the last couple of years, and Australian investors arguably got the benefit of this if they sold, was Square or Block's acquisition of Afterpay, almost at the top of the buy now, pay later bubble. And I think they bought it for $40-odd billion.
That's insane.
And now Square's market cap is the same as that. So that's another one. They're probably the big ones, I would say.
Yeah, no, you've covered that off quite nicely. The only amendment I'd make to that is that you started off with the size of the deal and then went to rationale. I'd probably go to strategic rationale first. I think sometimes large deals may get a pass if there's a decent strategic rationale for them. But you're absolutely correct. When the presentation is very telling, if the presentation is all about synergies, cost synergies or revenue synergies, they are both can be quite revealing, and all about share price accretion rather than what the strategic rationale is. I think that's a really big giveaway. Graham, do you have anything different on your list, or is the ordering of importance different?
I think that it does. I think, touching on what you just said about the size, I think it does tend to work better when the companies aren't preaching about it so much. When you get a one-page press release, that tends to work better, just because it probably means that the company isn't trying to make some massive claims about it, for one, to justify some other issues that are going on probably. And there might even be a case for looking for acquisitions where it doesn't even trigger the price-sensitive announcement clause. These small acquisitions mean the company probably isn't needing to preach about it to kind of justify it. They're just kind of making these small bolt-on acquisitions that gradually increase profitability or efficiency. If they're small, then the company also probably hasn't been kind of hyped and pitched by every investment banker out there. It's just one company going after a smaller competitor or purchasing, I don't know, some oddball division from a larger company that doesn't need it anymore. And
that's actually a really important
likely.
point there, Graham. I want to stop and dwell on that for a second, because the source of the acquisition is actually that's something I deliberately look at. Is the acquisition, is it coming from a banker or a investor, or is it coming from inside the company itself? I don't want to be too cynical about this, but I think people who don't invest full time for a living would be amazed at the naked self-interest on display in company strategy. So many acquisitions I've seen are just done because the share price needs to get to a particular level, or the management of both firms have agreed to option swaps, or someone gets a huge pile of money if the transaction goes ahead. You need to really search out those incentives, because it shocked me when I first started to realize how often these were driven by personal monetary reasons rather than strategic reasons.
And also just because executives get paid more the larger their company is. So they can spend the shareholders' money, increase the size of the company, and then a couple of years down the track justify, I deserve a much bigger pay cut because now I'm a pay rise because now I'm managing a company 50% larger or whatever.
John would be proud. We have become cynical old men, the three of us. All right, let's move on to a couple of examples here. Nick, why don't you go first? Good or bad, or good and bad, however you like to approach it. What's an example of a acquisition for you that kind of where you've used these rules to assess it?
Yeah. Okay. Yeah. Well, the first one on the good side is an acquisition Aristocrat made about a decade ago, I think back in 2012, of a business called Product Madness. Now, I'm hoping this won't...
You'd buy that for the name alone, wouldn't you?
Yeah. Well, I'm hoping...
For the IP on that. Yeah. Imagine the merch sales.
It's probably going to go down as one of those deals where no one really noticed it at the time, and probably even some of our listeners now don't remember it. But they bought the business for $30 million, and Product Madness was a really small company that was established in the mobile gaming industry, but still quite early on. They'd had the expertise and had the talent in place to really create content and roll out games well. Aristocrats saw this business and thought, oh, well, we don't want to miss out on mobile gaming and we want to get in early, and sort of took a punt that it might work out. But it was the strategic rationale was really interesting. So Aristocrat had all this IP from years of selling physical slot machines or poker machines, and that they could use that IP inside Product Madness to start rolling out these casino sort of slot machine games. And that's exactly what they did. So within a year of the acquisition, they rolled out a new game called Heart of Vegas, and that was mainly based off Aristocrat's IP.
Oh, I didn't realize that.
Yeah. And then and Aristocrat probably could have done this themselves, but it probably would have taken another 3 years. Instead, they just bought the talent and the expertise and then integrated their IP with it. And Heart of Vegas went on to be, and still is, one of the biggest casino mobile games grossing games of all time. And within 4 years, that division went from doing nothing in revenue to doing, I think, $270 million a year in revenue and over $100 million in operating profit, and was actually able to establish a few more games using Aristocrat's IP as well. So I think that this ticks a lot of boxes. It was a tiny acquisition, had good strategic rationale. Both sides were bringing something the other didn't have and could make a better 1 + 1 = 3 sort of situation. There was no transformation. It probably wasn't even a price sensitive announcement. I'm not sure, but it was very small because Aristocrat at the time was a $3 billion company and they're only spending $30 million. No earnings accretion, none of that. It was it's beautiful. It worked out well.
Yeah, no, I didn't even know about that deal. That sounds like it was done perfectly. Graham, I know there's a very obvious choice for you for the best acquisition, maybe the best acquisition in history. We'll get to that in a second, but I want to sandwich in with something a little more boring. Members might be aware that Brickworks was involved in a takeover with its major shareholder, Soul Patts, last week. Took everyone by surprise. This is a little bit different because it's Soul Patts is an investment business rather than an operating business, so they don't enjoy operating synergies as such, and there's no real product benefit or distribution benefit that you'd usually expect in an acquisition of this size. But what it did do was that it eliminated the cross shareholding that both companies have in each other. So Soul Patts owns about 40% of Brickworks. Brickworks owns about 26% of Soul Patts. And those shares reduced liquidity in the stock. And that was a major reason why a lot of fund managers, and particularly passive fund managers, didn't buy the stock. So by merging together, they're able to cancel all those shares, issue fresh shares to increase the liquidity, and that was actually the unlock of value. Was there was a lot of asset value in those businesses, but it wasn't being recognized because it was just Brickworks was an illiquid business that was perpetually undervalued. We had a buy on it at the time. We've had a buy on Brickworks on and off for as long as I've worked at Intelligent Investor, for about 15 years or so. So it's always been perpetually underpriced, and this helped unlock that undervaluation. And one I wanted to just highlight before I go over to Graham and his winning acquisition was Eagers Automotive, which has been a recent recommendation of ours and is basically done very well. But they've recently, at the AGM, they basically told us they're going to acquire something, and I think there was a shock in the room and a little bit of concern, certainly among the shareholders I spoke to. One thing that gives me comfort, though, is that they assured us that there was no outside bank or investor involvement in the target selection or in the strategy. This is all driven internally. And when a business with a track record like Eagers decides on a strategic move, I think investors ought to give them a little bit of leeway. So even though that's an example of breaking the rules, potentially going overseas and making an acquisition, potentially a large acquisition, I think when it is internally driven and comes with a stellar track record, I'm willing to bend those rules a little bit, which introduces the art of what we're talking about here, because you've got to judge when it is right to break the rules and when it is right to follow them. And Graham, I think your example, which I hope you're about to bring up because we're keeping everybody in suspense, that's certainly a rule breaker. No one saw that coming. There was very little strategic sense in it, and yet it turned out to be astonishing.
Are we talking about Pro Medicus here?
Is there anything else? Do you have another one? Is there another?
Everyone's favorite medical software imaging platform.
Surely there can't be another one like it. That's the most astonishing acquisition I have ever seen. Anyone?
Yeah, I don't think I can think of another, at least in Australia, that had anywhere like this kind of return. Yeah. So the company was tiny. It used to be, just dealing in a few different types of medical imaging, archiving and storage products. But then in 2009, it made a tiny deal. It was worth only $3.5 million.
Do you reckon they put out an announcement to the ASX that they bought this or not?
I'd have to go back if it
Probably
was a
not.
price sensitive. Yeah. But they then purchased Visage, a type of software that is used by radiologists for imaging displays of these very, very large files. And since then it has just gone from nothing market share to now not a dominant market share, but it has a decent chunk of the imaging market in radiology, and it's expanding into cardiology as well. But the company's now worth $30 billion. So it was, I don't know how many zeros you have to add there, but there's a lot of zeros that management has added through that tiny acquisition.
That brings us to another point, though. Surely a lot of that would be luck as well, right? I'm not sure these guys knew what they were buying at the time. They probably made an acquisition for a particular reason, but then quickly discovered its true value. Would you agree with that? I mean, we don't know for sure. We're speculating here, but I'd be very surprised if they knew what they were doing at the time.
Oh, yeah, totally. I think for a lot of these acquisitions that turn out really well, and actually some of the ones that turn out really badly, there's just a bit of luck involved. In the case of Pro Medicus, there was this big trend that developed towards cloud-based software. That was certainly a tailwind, but then it also had a few advantages in while this transition was happening, the kind of established companies like Siemens or Philips they weren't able to get away from their on-premises software. So,
and that introduces the biggest lesson of all this talk on acquisitions. And if you're going to do one thing, do this. Are you ready? Buy lucky companies. That's all you need to do. You don't need to have competence. You're much better off backing a lucky management team than a competent one.
Only buy the stocks that go up. It's so simple.
It's so easy.
Yeah.
Well, isn't that the old Napoleon quote? He said, "Find me lucky generals. I'd much prefer lucky generals than competent ones." I think the same thing goes for stocks. just buy the
We've
ones
solved
that go up. All right, look, I want to go through some of the messes as well. We've all kind of conveniently picked things that worked. Let's go around the other side, because this is probably easier to do, I would think. I can think of way more examples of acquisitions that haven't worked. And Nick, let's begin with you. There's one international stinker that comes to mind. Let's see if you pick that. I'll mention it if you don't.
Okay, sounds good. Well, my one's going to be Slater and Gordon's acquisition of Quindel.
That's a great pick. Not the one I was thinking about, but
okay.
Maybe better. Maybe better.
Okay, yeah. Anyway, this acquisition had it all on what not to do. So it was a large acquisition, $1.2 billion. So it doubled the size of Slater and Gordon's business. It was a UK acquisition as well. Now, Slater and Gordon did have some UK operations at the time, but still it's a large overseas acquisition. The presentation had used transformation, the word transformation 3 times. I looked it up and had it, most of the slides were dedicated to the things we spoke about for synergies, earnings accretion, the funding of the deal, not much on the strategic rationale, and which kind of made sense because there wasn't much strategic rationale here. Quintel at the time, and this is no joke, it had a really questionable history. So it was subject to a few short reports from, I think, Gotham City research, and that had sunk the share price from £6 to 30 pence before Slater and Gordon.
Jeez, when Batman is telling you not to buy a stock, you don't buy the stock.
Yeah, exactly right. And this company, and the short report sort of brought this up, had morphed from a leisure company that owned a golf course into a professional services business that had some legal operations as well.
I didn't know that. Wow.
Yeah, I didn't know it until I really started. I sort of remembered it, but I had to really go back and have a look, and I was like, oh my God, there's this red flags galore here. And it was also really complex. So the due diligence here involved going through 8,000 legal cases and making judgments on the success rate, the milestone payments on those cases, and when they would conclude. So it was big overseas acquisition, lots of judgment calls being made. They funded it through a capital raise and debt. So the net debt to EBITDA went up to 2 times. So most people would think that's comfortable. But
yeah, that doesn't sound too bad.
Only if the earnings are rock solid, and that was that's the suspenseful bit. They weren't. So I think within 6 months, Quintel had to restate all its financial accounts, and so all the profits that Slater and Gordon thought they were getting, or shareholders thought they were getting, were actually losses. So those debt ratios really started to blow out, and then eventually they wrote it all off, and Slater and Gordon's share price went from $8 to 8 cents.
Wow.
So just an unmitigated disaster. I mean, it has it all: large acquisition, large overseas acquisition, transformational red flag, not much strategic rationale, didn't know what they were buying. Yeah, terrible.
Incredible they went through with that. I didn't realize all that stuff about the leisure business. I don't know how they could go through with that if they had done any due diligence.
Yeah.
Great example. The one I was thinking of, Nick, was Time Warner and AOL, which probably to this day is that the worst acquisition in history, the most destructive, possibly. Yeah. I mean, the thing that rings true for me with that one, the lesson to be learned is buying fads, and this turns up again and again in acquisition history. Is when, and I'm sure we'll see it now with AI. There'll be companies who aren't involved directly with AI, but want the higher multiple that comes with AI stocks, looking for acquisitions. And so you've been warned now. Keep an eye on them. It's bound to have happened if it hasn't happened already. And we saw it with the internet boom in the 90s. AOL was was a hot stock. It was the internet stock in the American market, and Time Warner was a content business, old school, had a low multiple. And when that business merged, or one of them took over the other one, it was a disaster. I think there's more than $100 billion of lost value out of that acquisition. And I believe it's still the most destructive acquisition in history. But I stand to be corrected on that. One in a similar vein, a bonus one I'm going to throw in, is Rio Tinto's acquisition of Alcan, which is exactly the same formula. Rio Tinto at the time was a venerable mining giant. It invented the diversified mining model. The board was renowned for conservatism and countercyclicality. And then when the China boom came, and they did not get the multiple that other miners were getting because they were so conservative, they brought in a new CEO with an express mandate of go and buy stuff and get our multiple up. And so he bought the hottest stock in the hottest sector, aluminium. He bought Alcan, and I think it's the most destructive mining acquisition in history. They wiped off $40 billion of asset write-downs over 10 years. Wow. On that business. And to this day, they earn a sub-economic rate of return, even though they've written down, I think, the asset value by about $40 billion. An absolute disaster. And you could see it because they followed exactly the same formula as AOL, and the same formula that we've been talking about. Buying the hottest stock in the hottest sector at the top of the market happens again and again. Graham, your turn. What do you got?
Well, the one that came to my mind, though it doesn't compare with that one, but I'm thinking any acquisition that requires a significant amount of debt, whether the company is purchasing a company that already has lots of debt or whether they're using debt to make the purchase. I can't think of many where that has gone well.
Well, there is one particular one on the ASX at the moment that might be topical. WiseTech just took on $3 billion of debt to buy the thing they bought, which Nick would know the name of.
E2O. Yeah.
Was that on your list of concerns, Graham?
Well, yeah. I mean, WiseTech is in a slightly different park because it could pretty easily issue equity to cover that debt. But but the fact that it was using it, instead of raising equity was kind of odd, I thought. But anytime management is taking on a lot of debt, that can just screw things up so quickly. And I think Primary Healthcare's purchase of Symbion in 2008 is a good example of that. That cost the company $3.5 billion, and it wasn't moving. It wasn't one of those crazy outside the management's expertise kind of acquisitions. They already had medical centers and radiology and pathology operations, and this just enlarged them in many different ways, particularly the pathology division. But yeah, over time, all of those have done pretty poorly, except for the pathology division. Primary, which later became Helios, has since sold off the imaging division this year for just under $1 billion. It then sold off the GPs and medical centers for $500 million or so in 2020. And so all you're left with is basically the pathology division, and now the company's market cap is about $600 million. So I don't know what the losses were there, but something went terribly wrong. But getting back to the debt, this whole time for the past decade, 15 years, the company has just been completely weighed down by debt, so that something like a quarter or a third of its operating earnings were constantly going to interest payments, which means that it couldn't reinvest in different capital upgrades or invest in other growth initiatives, or even just kind of making the place a bit more efficient. So you've always got this weight. Management has this weight behind it that means that it can't do a lot of the things that probably that initial acquisition was supposed to do, make the place more efficient or add some strategic rationale. If you're running out of cash, you can't do the necessary changes. So yeah, Primary and Helios is a good example of that. But kind of where we are now, it's unwound a lot of these poor acquisitions. So you're left with what was kind of the core operation, which was a pretty healthy pathology division. And now, although it's not earning anywhere near as much as Sonic Healthcare, which is the leader in Australia. It still has a 30% market share compared to Sonic's 45%, and yet its operating margin is just 1% versus Sonic's 9%. So there's a huge room for improvement there. And I think maybe getting rid of all of the crappy acquisitions over the years will now let management focus on actually getting back to its original goal, which was to make the place a bit more efficient.
Amazing, isn't it? I see that again and again as well. In the aftermath of a terrible acquisition, the cleanup almost undoes the problem in the first place, although it takes about 10 years. And then you do get some sort of, you can get some sort of improvement in the business after they've gone through that whole cycle. There's a 10-year cycle here, which I've seen several times play out. Big acquisition gets made, it hurts, it ultimately gets unwound, and then the business
management gets fired, new management comes in, says they're going to do the exact opposite, and suddenly everyone's happy.
Yep.
Isn't this a fun area we play in? Look, one final thing I will add before we head off, and guys, if you have another example of this, please jump in as well. We're sitting here almost sounding like we have perfect knowledge of what works and what doesn't. And it sounds like as though we never get caught out, and we do. So I wanted to bring up an example where it actually seemed like a good idea at the time and ended up being a disaster. And that's my experience with AMA. AMA is the largest body shop in Australia. They do crash repairs for all the major insurance companies. They had one large competitor. And that large competitor was owned by Amy, the insurance company. When that came up for sale, they pretty much doubled their market cap to pay for that. They took on a lot of debt and they issued some equity, but mostly debt-fueled acquisition. And I knew at the time, I wrote at the time that they had overpaid for this acquisition, but because it added so much to scale and it kept it out of the hands of competitors and it meant that their market share gains were so dominant, kind of let it pass and slide, ended up being an absolute disaster. Partly because it came just before COVID and COVID decimated the business. The balance sheet became a problem. A series of equity raisings came up. And then it also turned out that a lot of management issues in the business. But that one genuinely fooled me. You know, the strategic rationale looked good. Knew they had overpaid for it. The funding was a little risky. But the idea of building a dominant business completely fell for it. Have you fallen for any that come to mind, or probably not as bad as my example?
I tend to get crushed on margin compression.
Of course not. You don't make errors like that, Graham.
I just make different exciting errors.
Different ones. Nick, you surely don't, do you? Don't do anything.
No, I can't think of many, though. We do have an outstanding recommendation at the moment on Rentokil Initial, which is like the world's largest pest control business. And it's always been a great business, route-based economics. It works brilliantly. But they did this massive acquisition in the US, and it was transformational. And when I recommended the stock, it was after this. So I knew that it was struggling, and I thought the share price sort of reflected that. But, it's still an open question whether it does, because the struggles have only continued. Now the CEO is going to leave in 6 months, and as you said, it might be, if you going off your decade-long playbook, well, we're only 5 years into it, so there's probably a bit more to go. But that's one where it could turn out that way, where I'm pretty unsure of.
I sometimes find value investors, the hardcore value investors, are more interested in being right than in making money, and that's why they just hold on to stocks for years and years. So ultimately, when that cycle plays out, they can claim victory at the end.
Yes. Well, I'm hoping I don't have any of those traits.
We'll be watching, Nick. 5 years in, 5 years to go. We'll provide an update to everyone as we go along. All right. I think we're bang on time. Nick, thanks very much for joining us and loved your examples.
Thanks, Gaurav, and thanks everyone for listening.
Graham, pleasure as always. And thank you for, again, reminding us of how we missed Pro Medicus.
We definitely.
And for everyone else, thank you for listening.